Welcome to Tesla Daily News Podcast. It's Thursday, March 5th, 2026. Today, we're talking about 3 things investors actually care about: what's changing in Tesla's revenue mix in Europe, what's happening with demand signals on the ground, and how charging, autonomy, and energy storage are reshaping Tesla's long-term story. Story 1. Tesla just took a hit to a high-margin revenue stream in Europe. Here's the hook. 2 major automakers are leaving Tesla's European carbon emissions pooling arrangement for 2026, and that could mean less easy money. Context first. Tesla has historically earned regulatory credit revenue by selling, or effectively monetizing, its low-emission status. In Europe, one mechanism has been CO2 pooling, where automakers can group emissions results and pay lower emission partners. The details from new EU filings, as reported by Electrek, Toyota and Stellantis, are withdrawing from Tesla's EU CO2 pool for 2026. Those were described as among the largest paying members. Impact for investors. Regulatory credits have typically carried extremely high margins, so losing large contributors can pressure profitability even if vehicle and energy gross margins hold steady. The bigger point is that the market has been valuing Tesla less like a credit story and more like a scale manufacturing and software story, but credit revenue still matters at the margin, especially in quarters where automotive gross margin is under pressure. Takeaway: watch Tesla's next quarterly filings for how fast credit revenue normalizes lower in Europe and whether Tesla offsets it with software take rate, pricing discipline, or energy margin expansion. Story 2. Tesla's demand picture in Europe is mixed, and that matters for near-term delivery expectations. Hook. France is showing a sharp bounce in registrations, while Germany is dealing with labor tension and ongoing scrutiny around the Berlin area factory. Context. Europe has become more competitive, particularly from Chinese EV brands, and Tesla's year-on-year comparisons have been choppy. Investors are looking for clean signals. Is Europe stabilizing, or is Tesla losing share structurally? Details first from France. French outlet Citroën cites AAA data showing Tesla's new registrations in France were up 55% in February. Now the Germany side. The Times of India reports rising tensions between Tesla and a German union. Separately, Focus reports the German plant manager at Grünheide pushed back against criticism in a letter, describing claims of a crisis as misinformation and calling it an anti-Tesla campaign. Impact. The France number is a positive near-term demand data point, but investors should be cautious. Monthly registration spikes can be driven by delivery timing, fleet mix, incentives, or a backlog release. Meanwhile, Germany matters because Berlin is Tesla's strategic European manufacturing base. Labor friction can raise costs, disrupt scaling, or constrain flexibility at exactly the time Tesla wants to defend market share. Takeaway. For traders, the key is whether European momentum broadens beyond 1 or 2 countries. For long-term holders, focus on Berlin's operating stability, output, labor relations, and whether Tesla can keep manufacturing costs down while the competitive set gets better. Story 3. China competition is intensifying, and the charging race is getting real. Hook. BYD is testing 1,500 kilowatt charging, 3 times Tesla's latest 500 kilowatt supercharger peak, and that sets a new consumer expectation for fast. Context. Charging speed is not just convenience. It influences EV adoption, brand preference, and, importantly, the total cost of infrastructure per car if dwell times drop. Details. Multiple outlets including TechRadar and Les Numériques report BYD testing a 1,500 kilowatt flash charging setup in Shenzhen, with claims that it can add roughly 249 miles of range in about 5 minutes. Impact for Tesla. Tesla's supercharger network still leads in reliability and integration in many markets, but if competitors bring megawatt-class charging to scale, Tesla will need to respond either with higher power stalls, better battery acceptance curves, or both. This is also about perception. Investors should not underestimate how quickly spec sheet competition shifts consumer narratives. Takeaway. Tesla's moat here is network uptime, density, and software routing. But the next phase is power and throughput. Watch for Tesla's next supercharger hardware refresh and any hints about battery chemistries optimized for higher charge rates. Story 4. Tesla is opening up the supercharger network in more places, and that can become a meaningful services business. Hook. Malaysia is now seeing Tesla superchargers open to non-Tesla EVs at selected sites. Context. Opening the network does 2 things. It can create a new revenue stream from charging, and it can increase utilization on expensive infrastructure. The trade-off is congestion risk for Tesla owners and potential brand dilution if the experience degrades. Details. Paul Tan's Automotive News reports that Tesla Malaysia has started allowing other EV brands to use superchargers at select locations, with pricing reported at around 1 Malaysian ringgit and 80 sen per kilowatt-hour. Impact. In smaller markets, this is a practical testbed for Tesla's broader strategy, becoming an energy and charging platform, not just a car company. Higher utilization can improve returns on capital for the charging build-out. But if usage spikes, Tesla may need accelerated capex for additional stalls, which hits free cash flow near term. Takeaway. Investors should track two metrics: charging revenue growth and supercharger expansion pace. The story is less about one country and more about Tesla proving it can run charging like a profitable network business. Story 5. Autonomy and robotaxi manufacturing signals are starting to show up in the real world. Hook. Drone observers report a record public sighting of Tesla Cybercab units at Giga Texas, suggesting production is ramping. Context. Tesla's valuation has a big implied optionality component tied to autonomy, robotaxi economics, and software margins. Any credible signal of hardware readiness matters, even if full autonomy timelines remain uncertain. Details. Russian outlet X reports that independent drone operator Joe Tetmeyer spotted what it calls the largest publicly observed batch of Tesla Cybercab at Giga Texas, around 25 units visible, and noted end-of-line activity that suggests a higher production cadence. Impact. If Tesla is genuinely moving Cybercab production toward real factory rhythm, that's a sentiment catalyst, but investors should separate prototype buildup from commercial deployment. The near-term financial impact is likely limited unless Tesla begins operating at scale with meaningful paid rides or fleet sales. Takeaway. The key question is not how many Cybercabs are parked outside. It's when Tesla can pair vehicles with regulatory approval, safety validation, and a scalable operational model that produces recurring high-margin software and network revenue. Story 6. Tesla's energy business keeps quietly adding utility-scale credibility. Hook. Tesla Megapacks are now powering what's reported as Canada's largest battery storage site. Context. Grid storage is one of Tesla's most underappreciated segments because it can grow even when auto demand is cyclical. Storage also benefits from policy tailwinds and increasing grid volatility. Details. iPhone in Canada reports that the Hagersville Battery Energy Storage Park in Ontario is now live, using Tesla Megapacks, with capacity cited at 1,200 megawatt-hours. Impact. Utility-scale storage can be a margin and growth stabilizer, and it diversifies Tesla away from pure vehicle cycles. Investors should watch for backlog, deployment pace, and gross margin trends in energy generation and storage, because this segment can move the narrative when automotive margins compress. Takeaway. Energy is becoming a real second engine. Big deployments like this improve Tesla's reference list for winning future utility contracts. Market check and sentiment. Tesla is being pulled around by macro risk. Hook. Tesla shares slipped as geopolitical stress hit high-valuation growth stocks. Details. A Yahoo Finance report in Chinese notes Tesla fell about 2.7% to around $392.43 in the March 3rd session, described as the lowest since late November, with year-to-date performance down roughly 12.7%. Impact. On days like this, Tesla trades more like a risk asset. That can create opportunity if fundamentals are intact, but it also means catalysts need to be strong to overcome macro headwinds. Takeaway. Separate tape action from business action. Macro can dominate for weeks, but product, cost, and execution dominate long-term. Let's wrap it up. Today's big themes were pressure on Tesla's European regulatory credit revenue as Toyota and Stellantis exit the CO2 pool, mixed but improving demand signals in parts of Europe like France, and an accelerating competitive race in charging speed led by BYD's 1,500 kilowatt tests. On the bullish side, Tesla's supercharger opening strategy and large-scale Megapack deployments keep strengthening the services and energy narrative, while Cybercab sightings keep autonomy optionality in the conversation. For tomorrow, watch for any follow-up EU filings around emissions pooling, additional European registration data, and any fresh updates out of Giga Texas on robotaxi or production lines. If you found this helpful, subscribe to Tesla Daily News Podcast, share it with a fellow Tesla watcher, and follow for your daily, investor-focused Tesla Roundup.